Is there a recession coming up? And if so, how do we protect our home by paying off our mortgage faster? Hey, what's going on, everyone? This is Sam Kwok here with one of the Kwok brothers, and in this video, I'm going to show you how to pay off your mortgage even faster while protecting your home from a potential recession. Now, before we begin with the video, be sure to subscribe to our YouTube channel if you want to learn more about paying off your mortgage faster, saving money in the process, as well as investing in real estate. So, what do you guys think? Is there a recession coming up? If you don't believe so, then tell us why. And if you do believe there's a recession coming up, tell us why as well. Go and share your opinion down below in the comment section. We'd love to engage in a conversation with you guys. But let's say there is a recession coming up. Now, whether this recession happens this year or next year really doesn't matter. We want to be protected regardless. So in 2008 to 2012, in our last great recession, people lost their homes due to two main reasons. Number one is that they had too much debt. They had more debt than 70% of their home value. So debt that is more than 70% of their home value. And the reason why I say this is that in 2008 and 2012, through 2012, the home value dropped as low as 30%. In fact, some states like California, New York, it dropped even more in certain areas. So what happened was that as the home value dropped 30 to 40%, they ended up owing more money than what their home value is. So for example, if your home value is, say, $100,000, to make the math simple, and right now you owe $70,000, in the last recession, a lot of people's homes, the value fell from $100,000 to $70,000 or less. So what ended up happening was that people were pretty much tapped out when it came to debt. They had way more debt than what their home value was. The second ingredient to this mess was that people didn't have savings, or the technical term is liquidity. Now, liquidity refers to the access to cash, right? How much cash can you have access to? Now, even the folks that had 6 months of savings, it was quick, it quickly dried up, right? Because obviously people were struggling to find jobs or income. Their debt payment was high. So a lot of people felt this crunch in their finances that they couldn't pay for the monthly payment. The bank may have came to them and said, hey, listen, Mr. and Mrs. Borrower, it looks like that your home value, in fact, the average of the home value in your area has fell well below 30%. We want to make sure that you're not underwater, meaning you owe more than what your home value is. So a lot of times banks can come back and say, hey, listen, you need to catch up. You need to pay $10,000, $20,000, $30,000 just so that you're not underwater. And of course, people didn't have $10,000, $20,000, $30,000 to fork over. I mean, it was a recession, right? And plus, the people didn't want to lose their savings and their liquidity over just to pay for what the banks were demanding to keep the mortgage current. So this caused a lot of issues. So my argument is if there is going to be a recession next year, or if you believe that there's a recession sometime in the next 10 years, I believe it's super important for you to pay off your mortgage even faster. And we also want to have access to this, liquidity. And I'll show you throughout this video how to get access to liquidity while paying down your mortgage even faster. Now, stick around this video. I will leave a little gift at the end of this video. If you stick around, great, you'll get the gift. If you don't, well, too bad. But the reason why we want to pay off our mortgage, there's a couple of reasons, and I'm not a big fan of the 30-year mortgage in the first place, and I'll show you why. In a 30-year mortgage setting, this is what's known as the amortization chart. The horizontal line you see here that goes from left to right represents the amount of time you spend on paying your mortgage. So 0 to 30 years, right? This vertical line represents the monthly payment you pay every single month. So again, simple numbers. Let's go and say $1,000 a month is your mortgage payment. That's principal and interest, okay? Now, this line right here represents what's called your interest payment, okay? And this is, so the interest is proportion to the monthly payment. I'll explain if you guys aren't understanding. This blue line I'm going to draw here represents the principal. And I get a lot of flack on misspelling principal quite a bit. So there we go. So this represents principal. This black line here represents interest. Now, out of the $1,000, beginning of your loan, so towards the first 10 years or so, 10 to 15 years, majority of your monthly payment goes towards none other than the interest. So I want you to go take a look at your mortgage statement right now. If you guys are curious, if you guys want to fact check me, whatever you guys want to do, majority of your monthly payment, if you just got started with this mortgage in the last 5 years, I can bet that vast majority of your monthly payment is going towards interest, unless you have like a 2% loan, okay? But in most cases, a lot of you guys watching this, looking to pay off your mortgage, most of you guys are gonna have a bulk of your monthly payment go towards interest. Now, this isn't a problem if you can wait until the end of the 30 years. But what happens today is that the average American, and this includes Canadians and Australians, we move every 7 to 10 years, whether it's to relocate for a job or our kids go to college and we're downsizing, we sell our house, or some of you guys may refinance, which I have a separate video why you should never, ever refinance, because that's a huge, financial suicide, even if you're refinancing to a lower rate. I'll explain why it's a terrible decision. So about, people get to 7 to 10 year mark. I'm going to draw about an estimate, 7 to 10 year mark, okay? People either sell their homes or they go and get refinanced. Now, guess what happens when they go and try to sell their house or refinance? Well, they haven't had much time paying down the principal. So the closer they get to the 30-year mark, the more principal balance, the actual balance of your mortgage is getting paid down. In the earlier part, vast majority of your monthly payment goes to the interest. Okay, banks get to keep that money. None of that is actually contributing to the fact that you're paying off your mortgage. So most Americans are in this perpetual cycle, buying a house, selling it, not enough equity is built, right? Or they're refinancing, and then they're doing this over and over and over again, never really getting to the zone. Very few people I meet actually make it to this part because they're sticking around for a long time. So this is the issue. Okay, this is an issue where today, the culture and the economic culture has shifted, right? We don't see the day where you work for a company for 30 years, 40 years, you retire, and the company takes care of you. We don't see that as much anymore. You're more likely to have a new job every 5 to 10 years, or you're switching jobs, or you're relocating. So the way the 30-year mortgage is designed is not necessarily adaptable to the time that we need. So how do we get around this? So let me go and introduce you to a new financial instrument that's going to help you pay off your mortgage faster without making more money or cutting back on your expenses. So I want to introduce you to guys something called a home equity line of credit. And some of you guys may have heard of this as a HELOC. Okay, that's what's pronounced or abbreviated as home equity line of credit. People call it a HELOC. Now, this is completely different than a HELOan. Okay, a HELOan is completely different. Now, the word line of credit, this is very important. The difference between a home equity line of credit versus a mortgage, and I'll break this down for you guys. This is your mortgage, okay, and on the right side you're gonna put versus a HELOC. A mortgage is what's known as closed-ended, meaning when you make your monthly payment, you can't get that money back out. You can't reuse the principal portion of your monthly payment. On the HELOC, you can pay back and reuse over and over again as long as you're within what's called the draw period. Now, with the HELOC, it works just like a credit card. Now, the difference with the HELOC is that your home equity is collateralized with this line of credit. So mortgage closed-ended, it's one direction. Once you make that payment to your mortgage, if you need that money back out, again, we have to refinance. And some of you guys already know I don't like refinancing. And we talked about the front-loaded interest. Okay, front-loaded interest was when bulk of your monthly payment goes to the interest. The front side of the mortgage goes more towards the interest. Okay, so with the HELOC, here's what we're gonna do. Okay, you guys already know that with a HELOC, it's payback, reuse, much like a credit card. Okay, you guys have to remember that. It's a very, very important part. So with this HELOC, here's what we're gonna do. There's two options to go about it, but with the recession in the context, this is how I'm gonna explain to you guys. So we have a mortgage. Okay, that's closed-ended. We can't use, we can't reuse and pay back, right? Mortgage. Okay. Now, what we're going to do is we're going to go and replace this mortgage. We're going to replace your mortgage with what's called a first lien HELOC. Okay. So let's for example say, let's say we have $100,000 in this mortgage. All we're doing is just transferring that $100,000 into a first lien position HELOC. Now, from there, I'm going to use a different marker color because I want to avoid confusion and the mess. What we're going to do is we're going to take all of our income and paycheck into the HELOC. Now, some of you guys are like, wait, hold on. We're going to take all of our income and paycheck into the HELOC. Why in the world are we going to do that? That sounds ridiculous. Now, here's why we do this. The goal of the HELOC is we're trying to drive this balance down as much as possible. Okay, so let's say your income paycheck is $5,000. Well, what we want to do is we want to lower this balance as much as possible. Now, with the HELOC, it operates the way that the interest is calculated in a HELOC. It uses what's called an average daily balance, average daily interest. So what it does is every day, depending what the balance is, the banks are going to take a look at what your balance is every day, and it's going to calculate the interest for that specific day. With a mortgage, depending on how you set it up, it calculates the interest based on the monthly balance, okay? This is very important. You got to keep tracking. So with that being said, we're going to throw all of our income and paycheck into the first lien HELOC, which, by the way, your conventional mortgage and a first lien position HELOC, as far as the interest rate, there's not a whole lot of difference there. And I'll explain why the interest rate really doesn't matter when it comes to our strategy, because our focus is not on the interest rate. Our focus is on driving this principal balance down as fast as possible. By throwing all of our income and paycheck and savings in there, we're driving this balance down to $95,000. Whereas in a $100,000 mortgage balance, you're making very small principal payment every month, especially if you just got your mortgage. Does that make sense? So I know what your next question is, how do we pay our bills? So with the HELOC, remember, you can use that money. You can draw that money back out, right? So we're going to cover our expenses, okay? And I'll let you on a little secret. It's preferred that our income goes in on the first day of the month, preferred, okay? And some of my clients that I work with when it comes to the strategy, we try to customize this as much as possible to, some people get paid on the first day, some people, others get paid on the 5th, right? So let's pretend that we get paid on the first day of the month. And what we want is that the expenses go out on the very last day of the month. Last day of the month, okay? Now, what we're doing is, if we bring the income on the first day of the month and try to get all the expenses out by the last day of the month, guess what? For the 30 days in that period between the first day and the last day, depending on what month it is, 30 days, the balance was sitting at $95,000. There was one particular day where we had a $100,000 balance, and then let's say your expense is like $4,000. You have another particular day that's the expense is going to be back up to, or the balance is going to be back up to $99,000. And the very next day, because it's your paycheck day, it drops back down to what? $94,000. Do you guys see what's going on here? So for 30 days, remember how I explained that the HELOC calculates the interest on every single day, right? Every single day, the bank is saying, okay, it's still $95,000. Okay, the interest is this. Next day, oh, it's still $95,000. The interest is that. So you're essentially carrying. It almost looks like your balance that's subject to the interest is $95,000, not $100,000 when banks calculated it. Next month, it's going to look like $94,000 because you got that extra $1,000 of cash flow that's sitting in there. So next month, banks calculating that interest as $94,000 instead of $95,000. Get it? So on a mortgage side, banks are calculating off of that $100,000. $100,000 times 5%, you get the number. $95,000 times 5%. It's a less number. So you can see here that by switching over to a first lien position HELOC, not only do you have the advantage of driving the average daily balance down with this little mathematical loophole, but when a recession happens, when and if a recession happens, you lose your job, or you lose your income, you lose your business, whatever the case might be, whatever income source that you have the ability to tap into this home equity line of credit, almost like a quote-unquote insurance policy, right? You can go and tap in for that emergency fund if you absolutely need to have it. Now, I know some of you guys might be saying, well, Sam, I have a 6-month saving. I should be all right. I don't need the HELOC. Well, my question is, why not just throw the savings into the HELOC, drive this balance down even further? If your HELOC interest rate is anywhere between 4 to 5% interest, I mean, what are you getting on your savings account? Like 2% at most. I know some people I talk to, they get 0.025% interest. So instead of trying to earn 0.25% interest on your savings account, or 2% at most, why not save 4 to 5% interest by parking it on the HELOC and still being able to access that money in the future, right? So if your savings, let's say, is $20,000, park your $20,000 savings in the HELOC, drive this balance down even further to say $75,000. Now it's going to be $75,000 times 5%, which is significantly less than $100,000 times 5%. Does that make sense? But you still have access to the liquidity. You still have access to cash. So this is your recession-proof protection plan. Okay, this is going to be a way for you to protect yourself in case you lose your job. Let's say you're going to have a no job or no income for 6 months. Well, there we go. Right? While you're not going to tap into the savings account now, are you? Probably not. So when you need the savings account, it's there for you. Right? That savings money is doing that extra work of saving you 4 to 5% interest. So I know a lot of you guys might be asking at this point, well, what if they shut down my HELOC like they did in 2008 or 2009? What if they suspended it? What if they limit it? Well, with the first lien position HELOC, unlike a second lien position HELOC, it carries a significantly less risk according to the banks, right? Because if you accidentally default on the first lien position HELOC, well, that's the only lien, that's the only mortgage that you have, right? With the second lien position HELOC, there's not only the primary mortgage, but now you also have a secondary HELOC. Now you're deemed to be a riskier borrower. So I've done the research as far as how many people lost their homes because of a first lien position HELOC back in 2000 and 2012. The number that I found was 0. Not a single person that had a first lien position HELOC lost their homes between 2008 to 2012. And again, I would encourage you guys to do your own research when it comes to that number, but a first lien position HELOC is significantly less in terms of risk, according to the banks, and also you'll see a very relatively comparable interest rate between your conventional 30-year mortgage and your first lien position HELOC. So I did promise that I'm going to give you guys a free gift at the end of this video. So what I'm going to do is I'm going to give you a free calculator, an Excel sheet, to show you how much money and time you can potentially save by using this very strategy. So what you want to do is you want to go to chopmymortgage.com, go and download a free calculator. After you download the calculator, I'm going to invite you to join me on a 50-minute class. I'm going to go even deeper as far as how do you use a HELOC to protect yourself from a recession. How does the numbers work? I'm going to even show you the calculation of the average daily balance interest. I'll give you fun examples. I promise they're not going to be boring math, anything like that. I know I try to keep it nice and fun. So go and check it out. Download the calculator, chopmymortgage.com, and I invite you guys to take a free 50-minute class that I put together on how to pay off your mortgage faster using a home equity line of credit, and also use it as a recession-proof plan to help you through the hard times. So go and definitely check it out, chopmymortgage.com. I'll see you guys on the other side.